Well, good afternoon, everybody, and thanks for turning in to the weekly call. My name's Denny, and today is Saturday, July 27th, 2019. On the call today are the boys, Jim Sinclair, Bill Holter, and the famous Dave, and there is plenty to talk about. This week we were all subjected to more media blather than usual, and it's keeping a lot of the financial news in the shadows. Both Mueller and Epstein absolutely dominated the mainstream media. But it was at the expense of keeping most of the world in the dark about the financial drama that is building literally each and every day. The email from listeners continues, and the questions are good ones. You guys are sending in great questions through Bill. We will be feathering in listener questions in throughout all the call today, and in some cases we'll be giving multiple perspectives. But these calls are truly a blessing for all of us, meaning the four of us and you as listeners, because we can not only pull on Jim's deep experience in the gold markets, the gold industry, and his trading acumen, but we can also hear Bill dissect crazy complex financial circumstances in simple terms that we can understand. And then we also get the non-U.S. perspective on other world events and situations from Dave. Thanks for investing in the premium side of jsmindset.com. We are doing our level best to give you content you simply cannot get elsewhere. But always remember, we are not giving you investment advice. We are trying to give you a perspective of the economic world to add to your tool belt to be prepared for what might certainly be truly dynamic changes in the world. And with that, well, let's get started. We're going to start with Jim, and this is a question from Ela from all the way from Australia, Jim. Jim, you brought to our attention the leverage to gold of the mining shares and the now occurring transition. And we're in the midst of the transition, and it's certainly happening. Could you please define how you see the mining shares might act in a major crash? In other words, if I understand it correctly, this is from Ela, they will fall initially with the rest of the markets, and then they will recover. I believe that the recovery has not always been the case, though. Can you explain for Ela?
Well, Eli is using common historical thinking, where the event that starts gold slowly and progresses and builds upon itself until, like a deficit, it's just simply too large to be contained, and then wreaks havoc on the market and takes gold to very significant levels. I don't believe that's the way this one is coming. I think this one is coming as a abrupt change in monetary policy based on Bill's correct analysis that there isn't enough money to pay, there isn't enough cash money to pay off all the debt that's been accrued since 1997. And because of that, we're going to run into a form of a reset, where there's an attempt to create new vehicles in order to be able to continue old ways. And one of the things that we've been hammering on for all of the time that we've been speaking before that is QE to infinity. And it was nice because it rhymed. And then they went and changed the name. So it's very simple to change the name. It's very hard to change economic law. Because QE, quantitative easing, is debt monetization, which is buying your own debt, which is the ultimate way to inflate. Nothing works better, nothing works more effectively than buying your own debt. Except this time, they put two little zingers in there. One, you can control it by the way you use it, and two, you can control it by the way you spend it. So what they're talking about is creating money for not monetary policy, but fiscal policy. The difference is monetary policy is playing games with interest rates, and fiscal policy is a lot like what Roosevelt did, although he did both, where he built trails, and the Appalachian trails and highways, etc. And they honestly believed that they sterilized QE by to some degree by the means it was used. And it's easy to see how they fell into that trap, because the money that was created went into a black hole called over-the-counter derivative debt. So the money that they created went into a hole called debt. And it came out of the banks. Remember, Goldman Sachs never lost a nickel trading any day for how many years? And as a trader, you and I, Bill, know that that is the ultimate absolute impossibility. You're going to have a losing day. So what they've done is they've taken two events that traveled with the last major QE adventure and misinterpreted them as making QE controllable. QE is not controllable. It's only controllable when there's a natural situation out there. The natural situation out there was the tremendous black hole losses that major investment houses had taken on the derivatives, and the money then coming out of the firms, the profits, going into the pockets of the people who own the firms. No correlation whatsoever. They push the button to this modern stuff, and they are going to push the button to a nuclear experience in the U.S. dollar. And they're going to push the button, and they're going to get the nuclear experience for the wrong reasons.
Jim, when that nuclear experience happens and the markets crash, I think what Ela is asking from Australia, she expects all of the stocks to go down, whether they're mining stocks, whether they're manufacturing stocks, financial stocks.
Right.
But she's expecting that the mining stock, and we've all got our favorites, but the mining stocks will recover. I think her question is, what type of timing do you see that happening?
All of what I'm talking about is contained in June of 19 past to 2025. And, every monetary event that has been caused by, by a currency upheaval has had an equity market run violently higher before the crash in the currency restate. Has had a currency market run violently higher before the equity market has crashed. What Eli's thinking is that it's going to follow the same order as it did in history. My position is the stock market is having that tremendous run before the dollar crashes. And this time, instead of gold crashing with the dollar and gold shares crashing with the general equity market, they will simply shift to the huge fonts of capital that still are out there seeking returns, because the algorithms are run by momentum. They don't think. They have no conscience. They don't worry about anything except the electricity being turned off. So you have to see that there's something out there entirely different with no soul, running markets as blank, if you will, in the intelligence quota. We don't have artificial intelligence yet. God help us when we do. But right now, a certain word reported about the Fed triggers a certain reaction in algorithms. So I don't want to say to Eli, you're not wrong. but you're regurgitating history. The reason for this tremendous equity market is the currency, but it's backwards. Instead of happening after the currency breaks, it's happening before the currency breaks. And when the currency breaks, the general equities market breaks, but simultaneously the precious metals and precious metal shares rise violently, especially because the reset will come in two sections. First, the geniuses in the money centers, followed quite quickly by the geniuses in Russia and China.
All right.
Denny, let me jump in on that one.
Yeah, come on, Bill.
What Jim's saying is that Ella is probably looking back to 2008, and what you saw in 2008, you saw gold get hit, actually traded down to, I think, $699. Silver was smashed from $21 to $9. And, of course, the mining shares collapsed with that. And we have a completely different experience now. Back then you had the dollar, I guess, if I recall correctly, I think the dollar was trading at 75, traded as low as 72. Now you've got the dollar pushing par. This is a completely different environment today. It's the same environment, but its asset valuations are quite different today because you've got gold turning up, you've got silver turning up, you've got the dollar pushing par, and the next move in the dollar is down, not up. So to worry about mining shares, you should be buying, in my opinion, buying mining shares hand over fist, because not only are they depressed, but they're at extreme depressed levels versus the underlying metal themselves.
Finished in some circumstances, Bill. Totally finished.
Right. What was it?
10,000
explorers have gone out of business in the last 3 or 4 years.
They'll see no recovery.
Right. They're gone.
But for those who have survived, it will be a tremendous time. I mean, those who have made it, those who have somehow found financing and the wherewithal to hang on, wow, it's going to be nuclear at that point.
The survivors will be the richest in the gold field. Okay?
In my opinion, mining shares will, when all is said and done, will have made stock market history. What you're seeing today in the Amazons, the Googles, the Facebooks, I think will be completely dwarfed by a handful.
Something with earnings. Something with an asset.
Well, it's both earnings and the asset.
Well, I mean, look at the earnings that Google has, and look at the price it sells at. It's comical.
David, I want to jump onto a subject that is very scary for a lot of Americans. We all have friends or family that are on pensions. Government pensions, both state and federal, can be backed up by the full faith and credit of the underlying government. But with private pension, that's not always the case. We have the PVGC that steps in every once in a while to save a one-employer pension account. But there are things known as multi-employer pensions, and they're typically union worker pensions that work for different union contractors. And all the union contractors go together, and they have a multi-employer pension plan. But what is happening is some of the employers are going bankrupt, and because it is jointly and severally, when they do the credit facility or the liability facility on the books, it is jointly and severally. That means that if there's 100 employers on the pension plan and 2 go bankrupt, the remaining 98 have to pick up the balance of what those 2 that went bankrupt did. Well, now so many of them have gone bankrupt that the House this week passed a bill supposedly to stop the coming tidal wave where the remaining multi-employer pension plan, the employers just can't cover it. Dave, we are talking about billions and maybe even $1 trillion. And so the question for you, Dave, is what is your advice and counsel to share with anybody on this type of a pension?
Well, you have to first start with the belief system. And when I say the belief system, our modern pension system, and this includes state, city, federal, is a Ponzi scheme. Bernie Madoff couldn't stand trial because all he would have had is simply state is, I'm not doing anything that Social Security isn't doing. I'm taking new participants' money to pay off old participants' money and telling them that they made a fortune. Well, our whole pension system's that way. So probably what they're going to do, if you wanted me to take a back-of-the-envelope guess, is they're going to devalue the dollar so hard that, all right, we can give you this pile of money that we promised you, but it's really going to be worthless, similar to the Germany scenario. So if you're asking me what someone could individually do to protect themselves against, because a reset's a collapse. And again, the question is, you hear the President and Treasury Secretary out this week talking about, do we want a strong dollar? Do we want a no, we're going to keep a strong dollar. We know what's going on here. This is a Ponzi scheme, and we're just arguing about how they're going to divvy up austerity at the end of this Ponzi scheme, meaning how we individually are going to have to protect ourselves. Outside of physical metal, I personally, there's a lot of good ideas. Farmland, if you know how to work it, and I'm not talking about to make money. I'm talking about how to, survive. Because really, at the end of the day, all you're looking is to survive, and hopefully your investments, if you played it right, will reap rewards at the time that this reset or the end of the party occurs. So if you said, really, what can you do? There's not a lot out there. You can't play the art game unless you're incredibly wealthy, and I think that's a Ponzi scheme. You can't play the old car games. You want to try flipping houses, great. I know that game well. It's not really, not what I consider a viable alternative, especially heading into a crash. So,
Dave, it goes back to be your own central bank.
Correct.
Don't rely on a pension plan. Have your own pension plan on top of, whatever pension plan is promised.
And Bill, you've already given the arithmetic to how to figure that out. Mortgage times grams of gold on day of inception times price of gold versus buying power of that gold at now. There's your formula.
Dave, you gave. Oh, go ahead, Dave.
Yeah, just to finish off, what it comes down to is, it's very difficult for the average person. That's why they're trapped. That's why they keep the country in a job just over broke, because it limits your ability to take actions. And the actions that we're talking about for the average person, if they're a ham and egg type person, 6-pack type person, they're going to answer, so where the hell am I going to get the money to buy gold and silver? And again, that's a viable argument. You need to have cash flow. If you're going to buy 50,000, 100,000, 2, 3, 500, pick a number of gold or silver. So you got to start with, every month did I pick up a coin along the way? Because most people could buy a silver eagle every month for the last 20 years, or how many ever years Jim and Bill have been harping on. So if you didn't do that, then again, you didn't follow the advice that you're paying to get. If you're saying, how do I leverage into a profit? Well, that's not Bill and Jim's angle more than mine. But yes, junior miners would appear to be, the elephant in the room when the system comes down. And to the earlier response, again, what happened the last time may not be repeated this time, as Jim is saying, where, you may just see gold break out and anything resembling gold, even in its name, whether it's gold bond powder. Remember
bread.
This? Golden bread.
It went up on the American Stock Exchange every time gold went up. Gold bread went up.
It was ridiculous. So, that's probably the best I could say to them. I know a lot of people are relying on their public pensions. I feel sorry for them if what I think is going to happen happens. It's a city, but I don't see any way out other than Central Falls, Rhode Island. If anybody wants to know how that went, just look it up. Central Falls, Rhode Island. They killed the janitors, the firemen, the policemen. They all took a 50% plus haircut on their pension. There's precedent for it.
Most
Bill,
species on 4 legs. On 2 legs.
Bill, this whole pension backup process has been, Pelosi named it. It's the Butch-Lewis Act, and its honor. The name came in honor of a Teamster by that name who was instrumental in bringing this pension situation to all of his colleagues, and ended up having a stroke and dying. And the bill would create this Pension Rehabilitation Administration within the Treasury Department. So the Treasury is commissioned to sell bonds. Now, this is the key, to sell bonds and then lend the money back to the pension plans at a low interest rate. The plans would, now supposedly, over the next 30 years, pay back these loans. Bill, this just seems hopeless to me. Is it even possible? It's just a bailout, and there's not enough money to bail out, and there's no way, once they get started, that anybody's ever going to pay back these loans.
And QE has to have started a falsehood to base the opinion of the modern method on it as being a viable method to maintain the economy of tomorrow.
The bottom line is, where's the money going to? Where does the money come from? I mean, this is like
out of the sky.
It's a discussion on socialism, really, is what your question is, Denny. Where's the money going to come from?
Cyberspace.
It can't. They have to create the money. They have to water down the money supply. They have to devalue. They have.
There's
to
not enough currency. Yeah, there's just not enough currency to pay off debt. And so now all of a sudden the pensioners have really awoken. They're saying, oh, my God. And so now Congress is involved because...
But, Denny, in this instance, they're saying they're going to borrow money to backstop the pensions. I mean, you're talking about a government that already owes on books $22 trillion. And forget about the other, the future promises. You're talking about $200 trillion. The money
Bill, to found borrowed money is not possible. In other words, to make a liability into an asset by borrowing more liability is not possible.
Well, it is a bankrupt entity borrowing money to save a bankrupt whatever you want to call
entity.
The pensions. Entities, whatever.
And at some point, people say, no more. And that's when the dollar starts to spiral.
Jim,
that'll be all currencies spiraling. It won't be.
Absolutely.
Well, all currencies have only one way to go down. It's a race to the bottom. But the U.S. dollar has been considered to be the reserve currency, which is a replacement for gold. And if that isn't a crock, I've never heard one.
Jim, we got another question from a listener, Dale, and he had questions about your comments last week regarding the momentum curves. Now, understanding momentum, which is a term you use both in physics and economics, is challenging enough. Dale wanted to understand it better, including your mention of the Delzer momentum curve. So a couple of things.
The Bessler,
I've seen it. You know what?
B-S-L-E-R. I had about 10 questions. Everybody spelled it wrong. It's B as in boy, E-S-L-E-R, curve.
Thank you very much. You're the best mother-in-law I ever had, Bill. All right. So
not one thing, it's your mother-in-law.
Dale wants to understand the mention of the Bessler momentum curve. Okay, so with physics, we've got momentum and we got velocity. So I think what Dale wants to understand is what is the difference between momentum and velocity, and then he wants to understand what it means to gold and the mining investments. Give us a shot at this one, Jim.
Well, momentum is something which has a somewhat organized taste to it. And momentum rises and falls with the interest in the given entity. And momentum peaks when it reaches a standard trend line. And momentum breaks down. That signals the end of that favorite stock, be it Google or one of the Nifty 4. Volatility is defined as the violent up and down of an entity, which has no organization to it. It just comes swooping down on it, swoops out on it. You see this every day. I'd say that the best example of that would be the stick that you held up in the air and it took a photo. And the company didn't make a stick, and the company didn't make a camera. The company made a concept: you hold the stick up, you go skiing down the hill. So the Bezier curve is an arithmetic formula, and the Bezier curve does just that. It curves around to infinity. And as it curves around to infinity, it can no longer hold a trend. It's going to move out, up, down, left or right. And when it moves out, what it tells you, and it's a very good piece of information, something other is going to happen. Immediately then, you shift to your standard technical tools to determine whether you've seen a top or a bottom or the beginning of a consolidation. And it's that plus the Fibonacci, which when taken and laid down on the horizontal line, will give you timing, because there's no better timing tool than a fib. But it's not timing at a high price. The best timing it gives you is when to expect a significant turn or change in the share. And those two pieces of information were taught to me by Harry Schultz, and they were written about in the 1950s, then sort of just faded away. But for making money in a technical way, I've never seen any two concepts better suited to the human brain more so than the computer technology.
David, earlier this month, Amazon announced a business deal with this monster real estate company called Realogy. And I think all deals like this are for money, and it's pretty clear that it was designed to boost the sales for both companies. But now it's a behemoth, and now this real estate behemoth is going to offer real estate realtor services. It'll offer in-home services and $5,000 complimentary bonus to the Amazon Home Services. And I'm assuming that model is going to have to be a franchise model designed to give leads to local realtors, blah, blah, blah. Dave, this just seems like a realtor commission killer, another Amazon Main Street business killer it's going to suck whatever margins are left off to Amazon. Amazon is come into every industry, but I didn't see how it could come into the real estate industry, Dave. But, I think they may have pulled this one off. Have you got any perspective of this?
Well, yeah, a little bit. I'm familiar with what they're doing. First off, to get the $5,000 total credit out of Amazon, the purchase price of the house has to be $700,000 plus, if I'm correct on that number. So when that caught my eye, I'm like, really? Okay, so that narrows down the market. And part of it is Amazon wants to sell their doorbell camera, and all of their high-tech gadgets, including Alexa. I have a personal opinion about Amazon. I think Amazon is as deep state as Facebook is. And when I say that, who more than the deep state, the U.S. government, whoever you want to call them, wants to know every human's purchasing habits? Combine that with Facebook, knowing what every single person thinks about every single subject, from their cat to their goldfish, and then throw Google in the mix, and you have, throw AI into the mix, and you have the whole system's rigged. So, again, we're watching consolidation, what we're looking at. The real estate game, I always thought, was a unique one, because throughout my adult life, they've managed to keep roughly their 6% commission, give or take a little bit here or there. That's close to a racket, because, Denny, you know as well as I do in the private industry, somebody's always trying to cut your throat by undercutting you on a job, correct?
That's competition. Yes, sir.
That's competition. So these tech giants, similar to the defense industry, have become insulated from that because they are, to themselves, the market. How many defense contractors do we have now? 5 big ones, 6 big ones?
Sharks eat the sharks.
Yeah. We just saw this in the telecom industry. Now we have the telecom industry consolidating further. So why not consolidate the real estate and the, and the purchasing records of every human on the planet? I try never to use Amazon. Just buy from anybody but Amazon, because everybody else has it. So I believe it's part of the collection of data and information, and then them, again, putting spy devices in your house, from your doorknob to Alexa. That was my initial thoughts on it. I'm a very untrusting person, Denny. I mean,
yeah, I've sort of noticed in our short friendship. I've noticed that with Dave. Oh my God,
sounds like logic to me.
Yeah.
I know that goldfish is plotting against me. I just haven't figured out how yet.
I'll tell you what, though. If Dave trusts you, there's nobody else better in the foxhole with you.
Shoulder to shoulder.
If you're in a bar fight, I'd want you 3 guys with me.
I was looking up this Dessler curve, Betzler curve, Delzer curve, and all it came up was firearms made by Taurus, and it's called the curve, and it'll change how you carry concealed. That's what I got out of a curve. Yeah. Hey, Bill.
BEZLER, also known as French curves.
All right. Bill, this week I saw this post from Siegel Wolfgang Reck, and it was on the JS Mindset website, and new home sales missing projections again, and that even a mortgage rate collapse is not bringing enough buyers into the market to sustain new home construction. U.S. manufacturing is slumping to a 10-year low. The RV industry is getting killed by the tariff wars. Caterpillar and Boeing are not doing well at all, and all the while the Fed's telling us things are great. So Wolfgang asks you, do you feel secure? Explain, Lucy. What do you think here, Bill?
Well, you're watching the real economy melt. You mentioned RV sales. If you dig into the GDP report, the GDP report, the bulk of the growth for the quarter was RV sales. But then you look at the RV companies that actually do the selling of RVs, and they're all having a hard time. Their sales are down. So, I mean, on one hand, you've got the government saying, the economy's doing well because of RV sales, but yet the companies themselves are saying, no, our sales are down 20%.
Well beyond 72 months financing, Bill.
Right.
Well beyond.
Well, and I mean, home sales, it all goes back to the entire system is built on debt. There's too much debt. A lot of people can't take on more debt, and those that can, a lot of them don't want to take on more debt. Smells like 2006, 2007 to me.
Well, it is. And
but worse.
Something will have to trigger that, and what triggers that is the reset.
Jim, I got a lot of really nice comments from listeners about you this week that were really heartwarming. They really appreciate the wisdom, but they want to hear your perspective on so many different subjects that I can't get enough questions in front of you. This week, the hue and cry has gone out to the Fed to cut interest rates. I even heard comments from John Williams on Greg Hunter's website this week that we will eventually have zero interest rates. So here's what listeners want to understand. What do zero interest rates mean to corporate bonds? I mean, a lot of these, many of us have diversified portfolios with corporate bonds in them. Won't that mean that investors are parking money for nothing? And if we go negative rates, bondholders are actually going to lose money to park it in bonds. Jim, this is crazy.
Well, they're going to have to pay. You're going to pay the person you lend money to for the privilege of you lending money to that person, entity, structure, corporation, etc. And that is simply nuts. And at that point, you'd be better off buying something that doesn't yield interest rate called gold. Because the argument that the equity, in fact, pays interest rate just dissolved in that one sentence. And then it becomes what has a liability behind it, what does not have a liability behind it. So your choice is always a balance sheet choice when you go into a period where you really don't have the answer. You need to strengthen your balance sheet, or as Bill quite properly put it, be your own central bank. And being your own central bank in an intelligent way means run down your debt and run up your assets. And if that's all you do, you will survive quite nicely.
Bill, let me follow up on this negative interest rate situation just a little bit. From my standpoint, it's like the farming family who has to eat their seed stock in a bad crop year. Sooner or later, there's no seed left. So long term, what does it mean? It just seems that once we go negative on rates, we will never go positive again. Is this what you call the snake eating its own tail, Bill?
Yeah, that's what I've equated it to. It's a mathematically impossible scenario over any long period of time. To have negative interest rates, the system eats itself. There's no way the system can actually grow, because it goes back to debt is both a liability for one party and an asset for the other party. And by turning rates or pushing rates to zero or to negative rates, does it help borrowers? Yeah, of course it does. But what does it do to the asset side of it? And who is the asset side of it? The asset side are your banks, your insurance companies, your pension funds. Those assets with negative interest rates, what's on their books already gets pushed up in value. But looking out into the future, how can an insurance company provide an annuity or any type of pension product?
By buying gold with funny money.
Exactly. What's going to happen is the suitcase is going to split, and when that money starts falling out, it's going to go directly to gold, because gold is non-liability money, and everything else is a liability. And speaking of liabilities, I don't know if anybody caught this or not, but do you realize Greek bonds are now a lower interest rate than U.S. bonds? And I'm not saying the U.S. is, even a solvent entity, but Greece is insolvent 5 or 10 times over, and their 10-year bonds are 2%. And it was just, 3 years ago that the world was worried that Greece was going to take the entire financial system down. And now they can't get it. Now the world can't get enough of Greek debt. It's bizarro world.
We sort of got a nation make it mad first.
We sort of got a slow start on this call, but we're starting to crank and move in the direction where these listener questions are coming. Dave, I'm going back to you. It used to be said that in America in the 1800s, even in the early 1900s, that any family could survive on 10 acres, have a little bit in woods, a little bit in crops, And then as these family farms began to prosper, everybody was looking to diversify. So one of the questions that I received is that as they were successful in these small family farms, they were diversifying. They were buying gold and silver, but if we expand that out a little bit, there are still people that have gold and silver, but they also have traditional investments like stocks and bonds. And the sound traditional advice has always been that there are people out there with asset classes are almost guaranteed to fall apart, but it's still part of this portfolio theory where we stay diversified. Now, we just heard Jim and Bill talking about negative interest rates, what they're going to do to bonds. Any advice to listeners who still hold legacy stock market positions in order not to put all their eggs in one basket, and legacy bond positions, which used to be the stuff of widows and orphans? We are in never land right here.
Well, again, that is exactly true. And that's been done to us over the course of the last, probably since the 70s when we came off the gold standard, because that became the point in time where everything truly did change for a period of time. We entered the period where we were consuming our tail, as Bill likes to call it, wherein we couldn't afford what we wanted, so we bought it on debt. Well, we bought these traditional investments because we were trained like the seal at the circus, that the fish was going to be thrown to you every day at this time. If you've bought into that belief that, traditional split of assets and, you have to hold bonds and you have to hold real estate and you hold some over here, I understand your thinking, but I do truly believe that has been mistakenly taught to the public. And I want to say they taught it to them on purpose, because who else could you sell all this junk to if you couldn't convince the public that this junk was good? So as we say about interest rates right now, people own these bonds or are going to buy these bonds and be guaranteed to lose money. That's sheer insanity. So what are they teaching us? So if they hold traditional legacy positions, I would be very concerned if I was them. I hold none. Nothing along that line. And, to your question, I am, if you were to use the book, I am so over-leveraged into one side of this trade in my life that, they would say in college, well, that's not very sensible. Well, that depends on what you consider assets versus people's liability. Gold and silver are absolutely nobody's liability. I own them. They're mine. They're hid around the world, in various positions and trusts, every single thing done legally over the course of a very long period of time, all proper reporting requirements, everything that everybody wanted me to do, I've done. So I don't consider those as anything other than the only asset class that surely will perform in a collapse. Again, 5,000 years of history.
I'm with you. Jim, I'm going to expand on what Dave just said. We grew up in an era where if you wanted to be successful, you threw your whole heart and soul into your enterprise. If you were in business, if you're an electrician, you put every penny you had into inventory and you built your business. And then as you got more successful, you were taught that you needed to diversify, because if something happened to your business, you'd have nothing. So back to this diversification question that we're getting from listeners, you're the old trader, and you already know that great wealth usually comes from a very concentrated position in one asset or one type of class. But if it's not mainstream to invest in just one asset class, it gets truly scary for the everyday investor. We've been told not to concentrate our wealth. We've been told to diversify. And it's the old question is, what if I'm wrong? What if Jim's wrong? What if Bill's wrong and Dave's wrong? We don't give investment advice. We give investment perspective. So Jim, talk to us about diversification when it comes to investing in this type of environment.
You can't diversify unless you have money. Okay? What are you going to diversify? Chewing gum paper? So diversification is a subject for the wealthy, successful investor. And the wealthy investor made his money the same way that Jesse Livermore made his. He found a situation that he believed in. Sure, he traded it to bring down his average cost, but basically he sat on it like a duck on an egg. there is in the area of our interests certain items that can't go forward technologically because China has the supply tied up, and China will consume the supply in building the high-tech weapons and the high-tech telephonic and communication devices that they can buy. I wrote a book in '85 called The Strategic Metals War. And although it's changed somewhat because the technology has gone ahead so fast, but there's one item that doesn't exist anywhere outside of Tanzania and China, where a company blows their horn in Canada that they're loaded with it, but they're not loaded with it. All they have is a processing project. They don't have any of the material. So to some degree, yes, I do own and will continue to own items of extraordinary rarity. But this comes out of the fact that I had already owned what is called a minor metals trading house. And the truth of it was anything but minor, the metals. There is a situation. Take Bert. He financed the First Lady's hygienic products in the U.S. And he used to take some ribbon because everybody wanted to know how he did his research. But he put money down, and it became a very big thing. Next thing he financed was trucks that could cross the nation, refrigerated, from California crops to New York and make it with lettuce and things like that. There'll always be something of interest, okay? But it gets harder and harder and harder and harder to find. That doesn't mean you don't stop looking for it. That doesn't mean I don't look for it. He had control of Lloyd Xerox. So he had control of tinted windows and copying machines. It's sort of a tradition in our family that you go into the financial business to build your basis to own and operate other businesses. And I would have nothing would stop the transactions like that, except to get my money in hard times would be a lot harder than getting it in easy times. A company would have to pay a distressed company level to be able to get the funds.
All right. So
no, I don't want you taking, completely taking your eye off the things that might come your way and be pure logic and common sense, or you just become a one quack duck.
Do you remember the movie? The Graduate with Dustin Hoffman? I think it was in the 60s. I remember I was in high school.
Sure I do.
And the old guy looks right at Dustin Hoffman. He says, one word, plastics. And so for many of us, we grew up thinking that, okay, I can be wealthy or I can be poor. This is either going to, it's like going to Vegas and putting everything on the double zeros, the green double zeros. You're either going to be fabulously wealthy or not. So when people look at the things that we've been trying to teach and trying to talk about, they see it as risk because they don't understand the consequences if they don't take the bet at all. And I think that's what I'm trying to draw out of you. We still need diversification, but we need.
Right. Okay? Yeah. If it's right, take the bet. Don't go crazy, but take the bet in a modest way, but large enough to mean something to you if it's right. I mean, can you imagine my father with women's hygienic products?
Wow.
I mean, if that is, he's Archie Bunker. Think of the contradiction in terms.
Denny, let me jump in on diversification.
Yes, sir.
It's a great concept. It's a great thing to do during normal times. The only problem is these aren't normal times. I mean, how do you have bankrupt entities all across the world with 1%, 2%, 3% negative percent interest rates on their debt? That's not normal. So for the average investor that's taught, you go 60-40 stocks versus bonds. Well, if you're talking about a 0% bond market or 1% or 2% or whatever bond market, which way over the next 10 or 20 or 30 years are interest rates are going to go? Are they going to go down from zero, or are they going to go up?
Up.
So that's 40% right there on your typical 60-40 equity versus bond investor. And again, okay, so interest rates are going to go up, and you've got stocks at 18, 20, 25. Get into the Googles and Facebooks, 50, 100 times earnings, and that's based on 1 or 2% interest rates. What are those PE ratios going to be if rates don't even normalize to the 7% range? Let's say they normalize to 4 or 5%. And I don't think that's the case. I think you're going to see an absolute hyperinflation. The point being, during normal times, diversification is good. But when you have sovereign treasuries all over the world that are bankrupt, that issue currencies all over the world that are fiat and backed by nothing other than the full faith and credit of the bankrupt entities, why would you diversify in traditional products or investments that across the board will blow up once
it has to have an outrageous multiple possibility? And here's where I get another eye taken out by Bill. He didn't take my first one out. He'd take my second, though. And right now, there is a promoter, an underlying promoter, promoting a substance called fluorescent sand. Except fluorescent sand has nothing to do with the name of the product. It's just his zippy way of promoting it. He doesn't own any. All he's got is a process to make it. And processes are sound if it happens to be in Canada or the U.S., but not when it's in Azerbaijan and countries you haven't even heard of in Africa. Now, when I looked at that stock, it was 4 cents. For all I know, it's 2 cents now. But it interested me in the fact that here's where I get thrown off the show. 5G is not possible without it.
Oh,
and they're going to do the 5G.
See, Jim, what you're illustrating are special situations, and there's always room for special situations.
Yeah, only special situations for diversification.
But what I'm getting at is systemically, and for what Denny's asking because of Denny's background, is traditional diversification, stocks versus bonds, real estate, all, basically traditional investment.
They got no place in the new world. Okay?
See, that's what they need to hear, guys.
The reason being is all of these things have value and are priced where they're priced because of debt.
You're absolutely correct. We're all going to be living in Japanese buildings and sleeping in tubes.
Bill, take that just a little bit farther. You and I were talking earlier about we have fire insurance on our homes. We have automobile insurance on our cars. What I think that listeners need to understand is that this is not necessary. It's a baby step for you to get some insurance policy by owning gold and silver. But if a listener doesn't understand that gold and silver are real money, we just need to give them another reason to own it as an insurance policy for their lifestyle and everything that they own, because we are in perilous territory here. That's what I'm trying to drag home to them.
What you're getting at, Denny,
is first reset.
Gold and
Second
silver.
Reset is the bonanza.
Jim, as you said, gold and silver will be the last man standing.
My family always felt that way. I was educated to believe that. And that was always the basis of everything we did. We had a bank called Ward & Company in New York, and that was the basis of the bank, gold and silver.
I had somebody ask me, actually, probably a dozen times now, what percentage should I have in gold and silver?
Exactly, Bill. That's exactly where I'm going.
And, well, actually, if you go back a year ago, I was an expert witness in a case where the money manager moved over 10%. I think got up to 18-20% and got sued because gold and silver were down in price. And my answer, what percentage should be in gold and silver? Wall Street will say, and this is purely lip service. They don't really mean it because they'll push you toward an ETF, which is a paper product and there is no gold or silver behind it. They'll say 5% or 10%. My answer is, when this credit meltdown happens, whatever you don't want to lose, have in gold and silver.
We're on the same page, Bill. No different page.
Yeah, but the thing is, guys, a lot of our listeners are making baby steps. They have not stepped. They're not on the pier. They're not in the canoe. And
but
for instance,
that is the real answer.
Of course, it's the real answer.
Whatever you don't want to lose has got to be in gold and silver. And, people will come back, I'm just going to take my money, I'm going to buy an apartment building or some type of real estate. Again, what I said a couple minutes ago, everything has its price or what is considered today to be value because there is credit available to buyers to purchase that. Once the credit spigot gets turned off, everything collapses because buyers can't buy because they don't have the ability to go to the bank, borrow money, and buy it.
Exactly.
If I could jump in, I'll sum this up in one sentence for everybody.
Go for it, Dave.
Gold is a Tier 1 asset. Because, why? Because it's a Tier 1 asset. All this other stuff you're talking about is junk. The central banks have told us it's a Tier 1 asset. Well, what do you want to hold in your portfolio at the end of the day? The only Tier 1 asset that is nobody's liability. So, that should be the real answer.
Which knocks out all the ECB bonds, it knocks out treasuries, it knocks out Chinese debt, it knocks out everyone's debt because debt is someone's liability.
Unless you dig it out of the ground.
I'm going to throw this next question to Dave because this is the geometry. In geometry, we have theorems and we have postulates. And, Dave, you are so logically oriented. I know you've probably war-gamed a lot of different financial scenarios. As you say, you live in the fort. But like all of us, you've worked incredibly hard for your nest egg. And I know you're thinking all the time about the key characteristics of the reset. You've probably thought this out. So for listeners who have not thought about this at all, step them through your war game scenario and just what might happen. What will trigger what will be next, and then, God save us from the Mad Max scenario. But sort of step us through your thought process.
I'll give them the steps. They can study them. We've been watching it happen. Look at what's happened in Argentina. It's going to happen here. Look at what happened in Greece. It's going to happen here. Look at what's happened in Italy. It's going to happen here. We've seen the roadmap. It's the same over and over again. Mass devaluation of the currency, where what you thought you had was an asset all of a sudden becomes a liability. Unfortunately, for whatever reason, Americans don't think that could happen here. I mean, go around the world. They named it austerity because rather than just saying, well, you're screwed. I couldn't understand austerity, and then the Trioca was going to administer austerity. We're going to get austerity. That's, how fast it happens, is anybody's guess. It normally happens overnight. It's, again, the road warning signs have been there for the last 50 years since we came off the gold standard. So if you keep ignoring the warning signs, saying, well, I could drive 70 miles an hour, I don't care, it's foggy, you end up in a pileup. And I believe that's what's going to happen. We're going to have a pileup, and it's going to occur rather quickly. And if you want a roadmap for what it looks like getting there, look at Greece. They're living on half of what they lived on 10 years ago. Think about that. How many listeners want their income to drop by 50% over the next 10 years?
And their assets.
And their assets become worthless. Because obviously, if nobody's got any money, who's buying your assets except somebody like China who's stealing your farmland on the cheap? But again, we've witnessed it happen in every single country that's gone down this road. I don't care if it's Brazil, go on any country, Turkey, look at their currency. That is the roadmap for what's going to happen. I'm hoping for not the Mad Max, because if that occurs, then we're really all in a lot of trouble. If you want my opinion on how it goes, I think the elite pull the plug. They hand the baton to China. The U.S. gets a 50% haircut. And all that debt that you're saddled with, you're going to take to your grave. And unfortunately, those leased Audis and Mercedes probably aren't going to keep happening. And as Amazon's trying to sell you a house for over $700,000, good luck.
Hey, Dave. You just said, and all that debt that you're saddled with, when your currency gets cut in half, is now twice as burdensome.
Exactly. That's where I'm going with this. So again, I truly believe we've seen the roadmap. If I'm just a guy strolling around the world and looking at the elite run this scam over on this country, then run the scam over on this country, having read John Perkins' The Confessions of an Economic Hitman, did nothing confirm what I knew was taking place. He was just an insider who told me, yeah, Dave, you figured this out a long time ago. You're not just some dumb Italian kid from the street. You actually learned lessons in life. We've been told what the roadmap is. They're going to use the economic hitman scenario on the United States. You witness it happening. Tariffs aren't working. You read off the list from Wolfgang of all the things that are just total BS that the government tells the best economy ever. 3% GDP, 6%. Yeah, well, we revised last year's GDP lower, and all of a sudden now this year's GDP, and that's even with them cooking the books. So, unfortunately, that's how I see it going. Just look at what's happened to every other country that's gone down the crapper before us, and start with Argentina. They're the most recent broke example. Greece, Italy, Portugal, pick any of them. The game's been run out of them. So to think that it's not coming here is either you're naive or you think we truly are special people.
And Venezuela, if you believe in socialism.
Right. Yeah, good. Right. I just rattled the ones that came to my head. But go down the list. It's happening everywhere, Same game.
I've got one more question for Bill and one more question for Jim. I think I'm going to go with Bill first. The silver to gold ratio has recently improved, Bill. At one point, we were well into the 90s. I think it was 93 to 1. In other words, 90-plus ounces of silver equaled 1 ounce of gold. Now, it started to come down. In the past, according to David Scheckman of Miles Franklin, we should expect it to drop to 65 to 1. But I don't know. Bill, what are your thoughts on choosing to invest in gold or silver based on these type of ratios?
Well, there's a couple of things. One, historically, just under 10 ounces of silver are mined for every 1 ounce of gold. So that's God's ratio. The traditional ratio back hundreds of years, has been 16 to 1, and the reason it was 16 to 1 was because, and this I can't tell you factually this is the reason, but in my opinion, the reason silver was discounted from the 10 to 1 God's ratio to 16 to 1 man's ratio was because you had to carry around 10 times as much. So there was a discount from the 10 to 1. I think it's total speculation saying 65 or 40 or 30 or whatever the number is. The bottom line is it's completely out of whack at 90 plus to 1. What it tells you is you want to be much more heavily invested in silver than you want to be in gold. And as the ratio comes down, then you peel off a little bit of silver and you put it into gold. The ratio comes down further, you peel off a little bit more silver. I'm sorry, a little bit more silver and move it into gold. The ratio at 90 to 1 is it's man-made. It's made by paper contracts. And an additional thing to think about is there's actually more gold stockpiled above ground than there is silver. And that's because central banks and people have hoarded gold for years and years and years. And roughly 70% of all silver that's been mined, it goes away. It's gone. It's in your cell phone. It's in your car. It's in your computer. It's in your solar panels. It's in medical products. You name it. There are hundreds of uses for silver. So when silver gets mined, it gets used, and it's gone. So when this reset happens, you're going to see a reset of silver versus gold for the reasons mentioned. God's ratio is 10 to 1. In other words, that's what it comes out of the ground at. And there are no huge stockpiles. In the 1960s, we had the ability to unwind the Manhattan Project, and that was 2 billion ounces of silver. That's all gone. There's just no huge physical stockpiles of silver remaining.
Thanks, Bill. This is a good point for me to remind everybody that we are not giving investment advice. We're trying to explain to you where the imbalances are, and we're trying to give you a perspective of in an economic world, just so within your own tool belt you can be prepared for what certainly is going to be a different, dynamic, changing world. Jim, I listened to Greg Hunter and James Rickard, and he doesn't think that the Federal Reserve is going to be able to, whether they can or can't, he doesn't think they will come in and ride to the rescue for what coming chaos is headed our way. He says that interest rates are 2.25%, but to get out of a recession, you've got to be able to drop the rates 4 to 5%, which would take us into negative territory. I mean, you get to 0% pretty quickly. And then what do? You're still in a recession, and you've got. I think what he is leading to is the only thing we can do is quantitative easing. We got to print the money because you're at a boundary. With a Fed balance sheet currently at $4 trillion, you've got this confidence limit. So Fed is not ready for the next recession, and they can't even get ready. Jim, something's got to give at this point, and I'm not sure what the next so-called recession might look like, because I think if we go in, it's going to be darn hard to get out.
The first reset will look like the SDR did to the original designers and to the public at that time and to the legislative at that time. Oh my, they solved the problem. But they didn't solve the problem. And in a situation as accelerated as we have now, it's going to become quite evident quite soon that outside of an asset, there is no solution to the problem. And the only solution to bankruptcy, as we discussed before, is up asset, down liability. The second reset will be a public affair, and it's in that second reset that China and Russia will make the price, and it can be any price they choose to make it.
Well, with that, listeners, I want to remind you that trying to get the information you are asking for usually means that you have to take a different position of thought. You are approaching a problem with traditional solutions. And if you've heard anything from Dave and Bill and Jim today, your assumptions might be wrong. And if your assumptions are wrong, then your conclusions are going to be wrong. So a lot of what we tried to pull out of the boys today was this horizontal, rotational, three-dimensional zooming from a different direction so you can actually see what the issues are. I encourage you to continue to send your questions in to Bill. Bill gets them to me and to everybody else. But, guys, you did a pretty good job with trying to get them moved over to looking at it from a different perspective. So good job. Dave, you got anything else for us?
Nope. Only words I can leave people is anything that we've been taught, you kind of have to question it. I mean anything. Because whoever's teaching it to us or taught it to us had an agenda. And, if you start looking at the Rubik's Cube from the belief that somebody created the agenda to benefit themselves over you, then you start standing a chance of figuring out how to protect yourself. Does that make sense to you, Denny?
Spot on, brother. That's exactly right. It's a different solution to a dynamically changing situation, that there is only a couple things that are going to be the lowest common denominator, and those are the things that you guys have talked about forever. Bill, have you got anything else to add to the soup?
I would just ask, how can the entity that caused the problem be the solution to the problem? I'm talking about central banks.
Yeah, I know.
Yeah.
Well,
that's a great question, Bill.
Yeah.
How does a person who plugged $20 million into defense spending to hide its robbery put it back?
It ain't never coming back, Jim.
Trillion, Jim.
Yeah.
Yeah, it's done. It's history.
Yeah.
We got a deal with what is today.
Well, Bill, I don't know what you're going to title this one, but we're getting to the crux of it, little by little. It is. I'm not even going to use the word.
Crux of it.
Yeah, it's a perspective shift, and we're not looking at it straight on. We've got to come at it at an angle, or we cannot let go of all those things we've believed our whole lives. We've got to come at it obtusely, and you guys sort of jerked us around pretty well that way today.
Well, it's a constant seminar. It's something that's never been done before, because it always picks up where it left off.
Well, we'll talk to you next week, boys. In the meantime, thanks for everything. I can't tell you how important these things are. And when I read these emails from listeners, you've got listeners all over the world. I mean, we got Australia reaching out to us here. And you know what's
going on? By the way, we're upside down. Australia's right side up.
Only in the summertime. In the wintertime, we're good, buddy.
Okay.
All right.
That's true.
That's it. Well, thanks a lot, guys. We'll talk to you all next week.
Have a great week.
See you next week, guys.
All right. Bye.